Welcome back to the second part of our dropping a segment presentation. Let's take a look at Katie's Performance Bike Company. Katie is concerned about the continuing losses in her dirt bike segment. She's losing $9,000 net operating income in dirt bikes, and she wants a recommendation from you about dropping the dirt bike product line. Overall, she's making $32,000. Her road bikes are making $41,000, and she's wondering whether getting rid of dirt bikes will really boost her income or not. The special equipment to produce dirt bikes has no resale value. Let's first walk through each of these line items on the income statement and decide whether those costs and revenues are relevant to our decision. First, let's look at sales. If we get rid of $60,000 in dirt bike sales, will we lose that toward the contribution of income to the company? And of course, the answer is yes, we'll lose those dollar amounts. What about variable manufacturing and selling expenses? They are variable with respect to sales. If we lose the revenue of $60,000, we will also lose the cost of $33,000. And you might imagine if we get rid of the dirt bike product line, the whole entire contribution margin of that product line, $27,000 contributing to the overall profits of the firm, will be lost. We will consider the contribution margin to be relevant as well. I made some notes here about why these costs and revenues are relevant, and we'll go ahead and insert the relevant amounts here. $60,000 we'll lose in revenues. We will lose $33,000 in variable expenses, which is a good thing. We will avoid, and contribution of margin of $27,000 will be lost as well. Now, what about the fixed expenses? We'll go one by one through those. The first expense that is fixed that we're looking at is the traceable advertising expense. And we learned about traceable expenses that if a product line goes away, the cost that is traceable to it will go away as well. So is traceable advertising expense a relevant cost in making this decision? And the answer, of course, is yes, because it's a cost that can be avoided. So I'll just type in avoidable at this point, and we'll lose or avoid $6,000. What about depreciation? Depreciation on special equipment is $8,000. There's a note in the facts that the special equipment to produce dirt bikes has no resale value. That means we can't sell it for anything if we do get rid of the line. Do you think that this is a relevant cost that we can avoid? And the answer that you've learned is no. Depreciation is not a relevant cost. It is effectively a sunk cost. We paid for this equipment when we bought it, which could be several years ago, and depreciation is simply a mechanism for recognizing the expense of using up that equipment over its useful life. This is not a relevant cost because it is a sunk cost. What about the salaries of these product line managers? Are they traceable to the product line? Well, yes. If we get rid of the dirt bike product line, we'll get rid of or avoid $10,000 worth of product line management salaries. So we'll say that is a relevant cost because it is avoidable. And finally, what about allocated fixed expenses of $12,000 for dirt bikes? We have learned that allocated common fixed expenses are just that, they're common. And if we get rid of a product line, it doesn't mean that the allocated expenses will go away. In fact, the company will continue to pay for them. They will continue to exist. We will say that because we can't avoid those common fixed expenses, that they are common and not avoidable. Let's take a look at where we are so far. The contribution margin that we're losing is $27,000, but the costs that we're avoiding, the fixed costs that we're avoiding, are $16,000. The contribution margin that contributes to profit is higher than the cost that we won't have to pay That's not a good thing. The contribution margin lost exceeds our avoided fixed expenses by $11,000. I think we're going to be $11,000 worse off if we get rid of the dirt bike product line. In the pro forma income statement that you see on the screen, I took the liberty of showing the impact on the current company totals if Katie drops the dirt bike product line. So you can see that the sales currently are $300,000, and if Katie drops the dirt bike line, she'll lose $60,000 in sales. Therefore, her revised sales will be $240,000. And overall, we see that Katie loses $11,000 in profits if she drops a dirt bike line. So her net operating income goes from $32,000 to $21,000. That isn't the result that she was hoping to attain. The reason that she's losing so much in profits from divesting the dirt bike line is that she's losing a contribution margin that is higher than the fixed expenses that she would be avoiding by dropping the line. We can simplify our analysis if we focus on the contribution margin lost rather than focusing on sales lost and variable manufacturing and selling expenses avoided. Contribution margin lost is $27,000, and it is higher than the fixed cost avoided, so we know that we will face a decrease in company net operating income of $11,000, even without putting a full income statement together. So the recommendation that we'll make to Katie is that dropping the dirt bike line is not a good decision. If dirt bikes are dropped, the company's net operating income will decrease by $11,000 from $32,000 to $21,000. I hope you enjoyed our discussion about evaluating the profitability of business segments. See you in the next video when we discuss the decision to make or buy a product.